All right, let's get right into it, because the market today is sending some seriously mixed signals. I mean, on one hand, you see signs that are telling you to be cautious, but then on the other, there are these pockets of real, genuine strength. It's like a classic tug-of-war, and we're going to try and make sense of it all.
So what's the deal? Is the market strong? Is it weak? Or is it somehow confusingly both at the same time? It really feels like a paradox, doesn't it? But the data is telling a story, and we're just going to follow the clues.
And just look at this. This is the core of the confusion right here. On the one side, you have the entire S&P 500 index, the big picture, down just a little bit, a sign of weakness, right? But then, on the other side, you have 63 different stocks hitting brand new 52-week highs. Now, that is not weakness, that's a sign of some serious confidence. So what is actually going on underneath the hood?
All right, to get to the bottom of this, let's start by decoding these mixed signals. We'll begin by looking inside the market itself.
You see, the overall index being flat can be really deceiving. The real story is almost always hidden away inside the individual sectors.
And bam, here's our first big clue. The S&P 500's 11 sectors are split almost perfectly down the middle. You've got 6 that finished in the green and 5 that finished in the red. This is not a market that's moving together. This is a market that's completely divided against itself.
This whole conflict gets even clearer when you look at the heavyweights, the sectors that have the most influence. Technology, which is nearly a third of the entire index, is all over the place. Financials are looking cautious, and even consumer cyclicals are barely posting any gains. The biggest engines of the market just can't seem to pick a direction.
So if stocks are this torn, where are investors going to find some clarity? Well, a lot of the time, the answer isn't in stocks at all. It's in commodities and bonds.
And here, the picture is way less confusing. People are flocking to traditional safe haven assets. Gold is hitting new highs. Silver is up over 8.5% just in the last month. This is a textbook defensive play that investors make when they're getting nervous about what's coming next for the economy.
Now, there's another really critical piece to this puzzle, and it's this number, 4.25%. That's the current yield on the 10-year U.S. Treasury bond. It's probably one of the most watched economic indicators on the entire planet. So the question is, what is it telling us right now?
Well, to really understand that, we have to go one level deeper and look at the whole yield curve. And trust me, this is where things get really fascinating.
So what in the world is a yield curve? Let's keep it simple. It's just a line on a graph. It shows you the interest rates you'd get for loaning money to the government for different amounts of time, from super short term to way out in the long term. And believe it or not, the shape of that line can give us some powerful hints about where the economy is headed. And the shape today is what's really key. It's getting steeper. What that usually means is that investors are expecting the economy to grow stronger, maybe with a bit more inflation, way down the road. So they're demanding higher interest for locking their money up for a long time. It's actually a sign of long-term optimism, even with all this short-term nervousness.
Just look at the difference here between the 2-year yield and the 10-year yield. The longer-term one is higher, which is normal. The spread between them is positive. That means we're avoiding something called an inversion, which is a classic warning sign of a recession. So the main takeaway here is that the bond market, well, it isn't screaming recession, at least not yet.
Okay, so let's recap. We've got stocks telling one story, commodities telling another, and bonds telling a third kind of mixed story. So how do we put all this together? Is there a way to boil all this tension down into just one number?
Well, the answer is yes. There actually is an indicator out there designed to do exactly that. It combines clues from the currency markets and the bond markets to try and take the temperature of the entire financial system. It's called the Mannarino Market Risk Indicator, or MMRI for short. And it's a pretty clever formula. It just takes the strength of the US dollar and multiplies it by that 10-year Treasury yield we were just talking about. The theory is, when both of those are moving in a certain way, it's a signal that stress in the system is building up.
And as of today, that indicator is reading 258.93. So of course the big question is that a high number or a low one?
The answer is, it's high. According to the indicator's own scale, any reading between 200 and 300 is officially classified as high risk. This tells us that even with those pockets of strength we saw earlier, the underlying tension in the market is pretty significant, and it's definitely something we need to watch.
So, with this risk indicator flashing high, what could possibly tip the scales one way or the other? Well, the market is basically holding its breath, waiting for new information that can help it decide which story is the real one, the story of strength or the story of weakness.
And that new information is going to come from two main places. First, from companies themselves when they release their earnings reports, and second, from the government when it releases its data on the health of the overall economy. So, if you're watching closely, keep an eye on earnings from companies like NIO and Signet Jewelers. And on the economic side, the really big ones are the manufacturing reports, the PMI data, and the latest numbers on construction spending. That's going to give us some fresh, hard data on how consumers and industries are really doing. And that brings us to the final question, the bottom line. We have a market that is clearly on edge and a risk indicator flashing high. So will this next wave of data finally calm everyone's nerves and give us some clarity? Or is it just going to confirm the very fears that are already driving people into safe havens like gold? The next few days are going to be absolutely crucial.